I'm Katie from All Raise. Wanted to welcome you to this wonderful session. We're joined by Pam, who is our CEO, and Pete Flint. We're really excited about the session today about how to weather and thrive during a downturn. I just wanted to go over some quick housekeeping items. We have a chat down at the bottom. So people who are attending the call can chat with one another, maybe introduce yourself and your company as well. We always love to see that. There's also a Q&A function, and you can put any questions to the panel there. Pam will kind of be looking at throughout the session, but then we'll have some time at the end of this session here, some questions to go through your questions as well. But we're really excited to see the folks who are joining, and I'll let Pam kind of take it from here.
Wonderful, thank you, Katie. And welcome everyone, good morning. We're excited to have you on the program today. I'm most excited to see Pete Flint. Thank you for joining us today. A bit of a bio and introduction for Pete. Pete is the managing director at NFX, which is a seed and Series A venture firm based in San Francisco that is transforming how true innovators are funded. And he's also the co-founder of Trulia. Pete was a serial entrepreneur who built one of today's most successful marketplaces. As CEO, Pete led the company from inception to one of the largest and fastest growing real estate websites in the US, with more than 50 million monthly unique users, and a merger with Zillow in 2015 that valued Trulia at $3.5 billion. Prior to Trulia, Pete was also part of the founding team of lastminute.com, a leading European online travel site that was acquired by Travelocity and Sabre Holdings in 2005 for over $1 billion. These experiences clearly gave Pete a rarely acquired understanding of what it takes to scale a company from a great idea to $1 billion plus exit, all from a founder's perspective. And then we also have his fabulous venture investing perspective now as he's joined the other side of the table. So we're fortunate to be able to tap both pieces of expertise. So Pete, welcome today.
Thank you. I wish it was sort of connecting with this community over kind of more happier times, but hopefully I can kind of share some perspectives.
Fabulous. Well, we are excited to tap in. So let's just dive in. As I read through your bio, it doesn't call out that you really do have a storied history as an entrepreneur, not just in building the category disrupting companies, but weathering unimaginable crises and emerging victorious on the other side. So what isn't clear in that bio is that you were a co-founder of lastminute.com, the online travel site, when 9/11 hit, which basically decimated the travel industry. And you were the CEO at Trulia when the 2008 recession hit, and there was, to borrow your own words, a catastrophic meltdown in your core market, which was residential real estate. So you have a lot of relevant experience to share with our participants today. And certainly history has a habit of repeating itself, and this moment does feel reminiscent of downturns if you've been through them, such as you have and I have as well. But we also find ourselves kind of in new and uncharted territories. What are the starkest kind of comparisons, similarities, and differences that you have as you look through the COVID-19 crisis and the associated economic downturn?
Well, yeah, I mean, it's, I guess, you know, sort of firstly, just reflecting on that kind of intro, I think there's sort of one thing that does sort of strike through is that while this is a harrowing time for many of us, all of us, you know, the software companies and entrepreneurs can find a path to great success through this. So I think that's kind of, you know, one of my core experiences that helped me through my experiences. You know, so I guess, you know, I've had the sort of good and bad fortune of kind of working through these sort of really challenging periods, and I think that reflecting today versus back in 2001 and 2008, the sort of obvious differences are that one is that those were kind of really sort of asset bubble driven recessions, whether that's in the tech market in 2000, 2001, and then obviously the sort of real estate and lending market. Whereas today it's obviously quite different. It's really a sort of biological problem as opposed to a purely economic one, but it's precipitating an economic collapse. I think probably the sort of biggest thing for startups is that this is sort of changing the way that we work and the way that we communicate. And I think that, to sort of guide companies through these challenging periods, there is a communication becomes paramount. And it's just so much harder to do that kind of through a computer screen. It's like, I think we all have these fears, anxieties, opportunities, hopes in this period, and to actually do it in this remote way, I think is particularly challenging for all organizations, and especially new organizations that perhaps don't have a fabric of communication and culture built up over time. So that's the sort of most stark change, which creates a whole set of new challenges for leaders. The other is the speed. If you go back in 2001, like the NASDAQ peaked in March 2000, and then really, I don't know when the bottom happened, but like it sort of felt that the bottom happened more than 18 months later, certainly after September 11th. And so you had this sort of like, steady sort of like erosion of value. And then in 2008, there was certainly the real estate market come down, and it sort of eroded, and then obviously October kind of collapsed. But I mean, what are we, like 4 or 5 weeks into this, sort of in the sort of maybe a bit longer depending on the market. This of change is remarkable, and that creates it's been remarkable to see the changes, but it also creates a whole bunch of challenges for founders and startups trying to navigate this environment.
So let's dig into that. What do you do to navigate the environment? So you recently wrote an amazing blog post with 28 moves to survive a downturn, not just survive, but thrive. And you break those 28 moves down into the categories of managing losses, gaining ground, and then managing psychology and mind over matter. So we will certainly share with those of you on the webinar today that link so that you can take a look at it, or you can search for it yourselves. But let's start with the managing losses, because that's kind of, I feel like, the phase that we're in right now. There's lots of, nearly 50% of the 28 moves are sitting there in the managing losses category. Yeah. So are there any highlights that you would call out to people? I mean, a lot of people are obviously looking at right-sizing their organizations. That's an important thing to do right now. But are there, what are the ones that you would say are maybe less well known but equally important?
Well, I think there's, I think the fundamental thing here is to accept the new reality. And I think I've been in, I'm on a bunch of boards and portfolio companies, and some of them have been like, okay, kind of day one, sort of accepting this kind of new reality. And the other is, there's another group which have been like sort of holding on to the kind of previous plan. And I think there is this sort of acceptance of this new reality, both internally and throughout the organization, which is paramount. And this is not, I think there was a view perhaps 6-7 weeks ago that this would be like SARS or like other these biological threats, which kind of, it's sort of isolated, we'll figure it out and then we're back to normal. It's like clearly very different in this time. So, that's accepting that your market has changed fundamentally, and so your product market fit may have changed fundamentally as well. Similarly, your financial plan is absolutely irrelevant. What you said at the beginning of the year for your 2020 plan, it's irrelevant. So just don't hold on to that, and it doesn't matter. So reforecasting, replanning is going to be critical, and then also just accepting that with the team as well. I think there is people in crisis, look, there's a degree of self-interest and anxiety that goes on with all of us. And so as a leader, to be sort of transparent that you don't know all the answers. This is the situation, and we are in the company that we had 3 months ago is not the company that we have today. And that can be incredibly challenging. And as a CEO, I found that myself incredibly challenging, because you've fought so hard, and you've been so kind of like decisive and and specific in setting out this vision, and you've been trying to get everyone in that same direction for so long, and then suddenly to change that, it can be very hard. So accepting that new reality. Yeah, the sort of other component we talked about is sort of runway and cash. And I think this is, it may depend on the sort of backgrounds of some of the leaders in the organization, but to start to get incredible precision on the cash position of the company. And I think, historically, founders have been focused on what's my GMV number. They've been focused on what is my EBITDA number, or what is my unit economics, like focusing on cash. And that's not to the detriment of those other numbers, but if you have a high degree of precision about what the cash inflows and outflows of the company are, then that is, that's just critical to enabling you to manage the success of the business, because clearly it's going to be harder to fundraise for many companies over the next 3, 6, 12, 18 months. But focusing in on, how am I getting my money from customers? How am I spending my money? Is there a way to sort of renegotiate leases, extend my payment terms, get money in faster? That kind of precision, everyone kind of needs to be an accountant right now. And many technical founders who are kind of more interested in building product than they are in necessarily kind of running the numbers need to have that high degree of precision on what is the cash inflow and outflow in the company.
That's great. I know there are a lot of women on the call, and while not universally true, there's always the conversation that happens about capital efficiency where women will raise less for a multitude of reasons, not because they necessarily want to, but they get what they get. And so a lot of them feel like they're already operating really lean and mean and cut to the bone. Is there any advice that you would give about how to look at that cash runway and make decisions specific to them when you might already feel cash constrained and cash strapped? And I truly mean that, not like, oh, we have to give up our lunch, but truly like, how can I lose? I only have 5 people in my company. How can I lose even 1?
Yeah, I think it's, I think one of the sort of fundamentals here is that you're not going to cut yourself to success. This may be a kind of short-term thing. There may be expenses that you have, sort of whether that's expensive agencies or perks or kind of activities which you can cut, but fundamentally you're not going to cut yourself to success. And so you have to grow to success. This is the sort of startup mantra. You have to figure out how to grow. I was, in 2008, I was part of the Sequoia portfolio at the time. And we were, I think we had just raised, and so we had some reasonable cash in the bank. But we'd also been in the real estate market. And so the real estate market kind of peaked in 2006 and was declining. And that obviously precipitated the financial collapse. So we were running incredibly lean and efficient during that time, because we had, it was the nature of the industry. Real estate in 2007 was really not an attractive industry to be in, because it had already started to decline. So I think many companies do have this efficiency baked into them. And so I think you kind of, there's definitely a sort of pragmatism and paranoia that comes to this, because we don't know when this will end. But I do think there's a degree of which founders need to trust their judgment. If you're not one of these companies that has been, sort of cataclysmically sort of, or decimated, so to speak. Right. So, if you're not in, so, whether it's restaurants or travel or something like that, then you kind of need to trust your judgment if this is, and look at the signals and say, can we figure a way out of this? And to not cut too deep. A simple way that's often used is, are you cutting into fat? And this is a bit sort of visceral, but if you're cutting into fat, you're cutting into muscle, or you're cutting into bone. And a lot of it depends on the financial runway of the business, but I think every founder has sort of cut into so-called fat. You know, there's sort of extra expenses that have been going on. Cutting into muscle is hard. You know, these may be the sort of the top salesperson or the top engineer in your organization. I think cutting into muscle is really tough, but you know, it may require to do that just to extend the runway to a period of time. But you know, cutting to bone is just, there's no recovery from that. And so I would, you know, there's a degree of let's plan for the worst and hope for the best. But I think if you're running efficient and you want to take the market, don't throw the baby out with the bathwater.
Great advice. And of course, you talked about gaining ground. You're not going to cut your way to success here. So in every crisis, there is also opportunities that emerge. And you have some very creative statements in your 28-point blog post. But there's also been a lot of questions leading into the webinar about some of the methodologies you used for finding those opportunities. And one of the big ones was, how did you listen to your customers during 2008 and distinguish between kind of the knee-jerk reactions of the marketplace from the true needs, and kind of seeing the thread that you need to follow to emerge successful?
Well, I guess I think there's a lot of noise going on right now, and I think it's worth and important for founders to take a step back and to say, well, do we really have product market fit? And this is the earlier stage companies. Do we really have product market fit? And there is product market fit is not black and white. And I would say, like, historically, there's a sort of spectrum. There's a standard deviation. It's like, but today, product market fit is way more binary than it's ever been. If something's working or not working, because if we don't have product market fit, the sort of nice to have products are kind of, they're clearly not selling, and the must have products are kind of absolutely kind of fly off the shelves. And so we've got this sort of inverted hierarchy of needs in terms of the sort of core staples of kind of fundamentals and nice to haves are not. And so I've seen how kind of, and I saw this in my own experience, you end up having this almost clarity around what is working on the organization, what's not working. And that often gives the team the ability to to stop doing the things that are nice to have and double down on the core things. How to do that, I guess, in reality, is just really deep diving into the data in terms of what is looking at and being able to sort of take out the historical perspective and the historical data and to say, what is happening right now? What products are selling? What engagement are we seeing? Where are people going? What articles are people reading? And focusing your efforts on those. And the data is obviously stops the sort of the loud voice in the room, or the loud customer is asking for something, and the data should tell that. And then if you just see a frequency of things where you start to say, okay, this is enough data suggests there might be some opportunity there. And I think there can be a sense of, in these environments, well, things are going to bounce back. Things are going to bounce back. We're going to be back in a kind of like in the old state before we know it. Unfortunately, if you look back in these recoveries, the change happens quickly, and it's happened incredibly quickly with COVID. But the recovery happens slowly, and so you start to see, back in 2008, it took years to recover. The same in 2001, it took years. And so whatever sort of unusual behavior you see happening today might become normal behavior in the not too distant future. And I think we will see how kind of long this happens. But I can see sort of downstream societal impacts of this becoming permanent. If this starts to accelerate, a digital reality, you know, these kind of the conversion to virtual, whether that's education, whether that's healthcare, whether that's groceries, like many of these sort of remarkable changes I see will be permanent going in the future. And that frankly is a great thing for startup founders in this environment. Startup software founders, you know, while it doesn't feel like it, this is a real gift of an opportunity, because everything is increasingly digital, incredibly virtual, and software companies are generally sort of pretty efficient in what they do. And so this is an opportunity for many companies to take this and to build tools, because the incumbents are going to be knocked sideways, don't have the capabilities. And this is very much an opportunity to lean into it. Maybe not in the sort of historical product, but in the future, this is absolutely an opportunity.
Is there any advice that you have for people around, you know, there's adjusting your business, and then the signal isn't there, the data shows that it's not there. Pivot can be an overused term, but like, no, you really have to pivot. Like your existing marketplace is not there. Any advice for people who have to do that hard turn pivot, and how to separate out, for every person who says like, oh, education's going to change, on the heels of this is probably a naysayer who says, no, it won't. And so how do you separate out, like, as you're thinking through a pivot, where are the true opportunities going forward?
Yeah, I mean, pivots are incredibly hard. I think there's, you know, the sort of the best pivots have been where companies have a sort of an asset or a capability or an insight, which they're able to leverage in a sort of entirely kind of new area. Those are a very famous example. The organization where where companies, really early companies, have just been, they realize they're banging their head against a brick wall, and they need to think about the new idea to help them through this. And that sort of process, ideating with a team, starting a third, is, you know, in whiteboarding sessions where founders are playing through multiple ideas to see what can work, and that process may be necessary for a bunch of companies. The easiest ones, if there's a pre-existing asset, they can sort of repurpose in different direction, but that they're sort of certainly incredibly hard to do. There may, you know, the reality is it's way easier when you're a small company. So if you are, let's just say, a Series A company or beyond, that realizes like what we're doing just will not work, you're often almost bringing the company back down to the studs. What is the sort of a very small team that enables you to move fast, to iterate, to think through the different ideas, and that's it's essentially a restart of the organization. But that's almost the only way to do it. If you're facing this reality of like, fundamentally what we're doing is not going to be applicable to consumers today, then, and you have lost confidence in that, then you might have to just do this sort of full restart. And the only way to do that is a tiny team where you can together identify that product market fit.
So we have everything. We've covered kind of the ground from cutting, cash flow management, opportunity, pivots, but managing psychology and mind over matter was the final piece of your blog post, which I think is so important, as in talking about authenticity of leadership in the forefront of culture in organizations. Do you have any advice and tips for people about how to best navigate through themselves, and most importantly their teams, through some of these very difficult times?
Well, certainly, just from a personal perspective, I think this is, I think you kind of know necessarily, I think it's sort of working around necessity, and exercise, and help people through this. The one thing different today is around the sort of human connectivity, which I think is particularly managing. So I think making time kind of made lonely. I mean, it's a bit of a CEO, particularly low right now. So, you know, I think it's, while it was a different time and without the same distancing, you know, in 2008, Trulia wasn't, we didn't hire anyone for a year. And I ended up doing quarterly dinners with, monthly dinners with a whole bunch of peers to get their perspectives how I was going through things. And so I'd find similar non-competitive spaces at similar stages, and I'd meet up with the CEOs, and we'd, you know, share different ideas, tactics, and half of it is basically not feeling like you're alone going through this challenge, and half of it is picking up ideas and tactics. So, and every other CEO was wanted it as well. And so they wanted the connectivity, they wanted to speak to peers, they wanted to share ideas, and so probably find activity of reaching out to people that you know or don't know very well, but with one degree of separation and organizing. And you're already probably doing a bunch of awesome stuff around this to help to find that connectivity. So just avoid that kind of that loneliness, I think, from a personal perspective. Like, on a company perspective, there's a, you know, what's critical is to help to communicate. You have a thoughtful plan and you're a transparent plan about how to figure this out. And the reality is that, you know, all the CEOs have hired great people, and those great people know exactly what is going on. They know the.
Oh, I think we lost Pete.
Oh,
there you are.
sorry, I don't know what happened there.
I think we lost you right as you were saying the CEO has hired some really great people.
Sorry about that. The CEO has hired some really great people, and so those people know exactly what's going on in terms of the environment and market. And can you hear me okay, Pam?
Yes, absolutely.
Okay, all right. So the CEOs know, the team knows exactly what's going on. So if you are, if you're not confronting the reality, then there is a degree of, you're just not going to be trusted in this world. So it's going to be critical for CEOs to explain the kind of the situation they're in. It's okay not to have all the answers, but to sort of be dismissive of the situation is just going to sort of engender a culture of distrust in the environment. So it's critical to be transparent, and you know, in 2008 there was experience for me at, like, you know, people were kind of scared in real estate. Online real estate in 2008 was possibly the worst industry to be in, but
right.
The people wanted to stick around. They were enthusiastic about the culture and the mission, and the reality is, you know, and this sounds a bit harsh, but the reality is that there is nowhere else for them to go. Companies are not, you know, the sort of, not that many companies are hiring right now, and so your team will be intensely loyal to you if you're able to kind of bring them along in this journey with you. And that's obviously really hard for over remote environment, but it's necessary.
Yeah, I think it's such an important thing. The authenticity of your leadership, the honesty with which you lead will turn around and pay back in terms of the loyalty of the teams that you have. Can you spend a couple minutes just talking about board management? Because I think that is an asset that people often, you know, may or may not have a good relationship with their board, how to best use their board. They may feel very vulnerable with their board right now. You know, you've been in the CEO chair, and now you're sitting on a lot of boards. So help us to, help share what your insights are about how a CEO can best leverage their relationship with their board right now to help them.
Yeah, so I guess first and foremost, your board are typically incredibly supportive of the team. They will get stressed and they'll get anxious and they'll perhaps have more time and want to know everything that's going on in the organization. But the board will fundamentally be on your side. I think just from my perspective on the bunch of boards that I'm on, it's the teams that are overly optimistic that create the most anxiety, kind of, for me.
Mm-hmm.
And it's okay to be optimistic, for sure, but I think there are if you are the sort of so-called paranoid leader, which is concerned about the future, not in an overly negative way, but just to be like, I'm pragmatic, I'm paranoid, things could get worse, then that is exactly what investors want to hear. They certainly don't want the company to sort of shut down and cut and throw in the towel, but a healthy sense of paranoia is going to be critical. And what I've seen as both an investor and also as an entrepreneur is, in some of these businesses, particularly network effect businesses, it's often the last woman standing that is the company that succeeds, the company that just sees it through this period, whether it's in 2001, a whole bunch of companies just had they cut things down to the bone and just scaled and scaled and scaled and came out the other side. Similarly in 2008, companies that cut themselves down and then came out the other side to be successful. So, and I think investors recognize that. So specifically for a kind of board, I think you have to have this, lean in terms of like, let's plan for the worst and sort of, some founders need to be wrestled to kind of lay off people, and that's understandable. These are your friends. Mm-hmm. But I think to be planning for the worst. The other is just the sort of chipping away bad news after bad news after bad news is really depressing in every context. So if you do have a whole bunch of bad news, just get it out straight away. Don't try and hide the situation. I learned this as a CEO. This was sort of pre-crisis, but we had sort of internal product crisis. We did a big relaunch and it was a failure, and I just had a sense of pride not to communicate this to the board effectively, and it created all sorts of elements of kind of mistrust and bad communication, and I, at the time, I resolved myself to kind of like, okay, I'm never going to get in that situation of trying to sort of unintentionally hold back information. So I ended up copying my board on all my weekly all hands communication. Just say, here's what we communicate, team. You get it as well. Saves me double kind of time to communicate. And I was I thought about the board as an extension of the company and just let the information flow. And that was incredibly refreshing and stopped me kind of having to communicate to different constituents. Keeping, I think fundamentally it's making sure that many of the board members see a lot of things across the different companies. So being engaged, highly communicating, and no surprises is most helpful.
Great advice. Let's shift tracks a little bit to your current role as an investor. You can't miss today's headline that the power balance has really shifted from the founder side to the venture side in the current climate. What advice do you have for entrepreneurs who need to raise cash in the next 6 months and the next 12 months? And that may be different based on the timing, but discuss bridging strategies versus new investors. Like, what kind of advice would you have for folks who need to raise capital? Because I'm sure there's several on here who are facing that conundrum.
Yeah, so I guess maybe sort of short term, capital needs, companies will need to raise, let's just say like in 2020. I mean, the best path is either going to be, it's likely to be sort of existing investors, whether that's some sort of bridge, or whether that is investors you have pre-existing relationships with. So those are going to be like the easiest tactics. The sort of reality is that while the companies have made a ton of progress, there is a strong aversion in the VC community to pricing rounds, to kind of like to really having a sort of understanding about what is, how do we effectively price these companies during this environment. So I would say flat is the new up. If you're able to get a sort of like same money in at the previous valuation, you should do that. And because the sort of consequent dilution is likely pretty small relative to the sort of downstream consequences. So, and I think from an investor perspective, investors are going to be looking at founders who are both leaning into this opportunity, not the kind of deer in headlights,
right.
But they're leaning into this opportunity. They're making bold moves. They are being aggressive into this environment, and they're also seeing some positive impacts in their business. That may be small, and it may not be universal, and it may be in a small sub-segment of the business, but leaning into the business, and then seeing kind of some positive signs in some elements. Those are the companies that will do fine. I think longer term, I mean, it's very hard to predict. I think there's a school of thought which says we're going to see 6 months decline, and then 6 months kind of like back to normal, and then 6 months to give you a window to raise money. Mm-hmm. That's probably the sort of best case scenario, 18 months. So if you can figure out how do you sort of find yourself to 18 months if you don't need to raise in 2020. And I think that while it's incredibly hard, I think there's a sort of clarity that comes with the thinking that what you have in the bank right now may be the last money that you're ever going to raise until you become cash flow positive. And I've seen good companies in our portfolio. I've said to them, you should assume that you would not raise money again. And in fact, for me in 2008, Trulia raised money in 2008 at a sort of healthy Series B valuation, but we were unable to raise an up round for 3 years after that point, even though we'd grown revenue something 5 to 10x. And so that sort of clarity of like, if what we have in the bank right now is all that we have, what should we do? And and obviously extend your runway, but figuring out how do you control your destiny and how do you scale, and that can often unlock a sort of breakthrough internally within teams, that they can find a path to, okay, how can we generate revenue? What are the things that we can do? Because obviously a down round, I think it will be challenging in a year's time. Companies facing really hard choices, kind of down rounds or bankruptcy. I actually think in a year's time it's going to be one of the hardest financing periods, because investors will be quite gun shy, having seen a whole bunch of companies go bankrupt, will be nervous about funding. Whereas today they might be doing top-up rounds, which you can close pretty quickly.
How about, there's a couple people who are submitting questions who are, not everybody is suffering. Some companies are really lucky to be exceeding. And so they're hiring, they're growing rapidly, they have enough cash in the bank. Any advice for those folks? I mean, on top of flat is the new up.
Well, this is your time to take market share. So I think this is absolutely the time to take market share. And I think there's, we look, ad rates have come down something like 50%. So I think for companies that have not been sort of, their markets have not been decimated, I think this is absolutely the time to lean in, but again, focusing on cash. So the sort of the notion here is understanding, first of all, obviously your unit economics, but also your cash cap payback period. So if you're not just your sort of your payback period on a kind of monthly basis, but when you're getting the cash back, and if you're able to get cash back from your customers in a less than 3 month period, this is your time to take market share. And I've seen that there are many companies, once they sort of like assess the situation, reforecast their numbers, because your sort of your cohorts, your LTV calculations, your CAC calculations have absolutely changed. Once you've got a sort of handle on those, like how can you aggressively go after this market? Are there sort of segments or creatives that you can use for marketing or for emails that you can capture this market? So this is absolutely a time to lean in. If you can go to investors and say, like, we've been handed this gift, which is a unique time in the market. This is going to be the cheapest time to acquire customers. They may be very supportive of that. And particularly those that you have a pre-existing relationship with, where they can get over perhaps some of the communication inertia. But I think this is this is an absolutely great time to start to scale companies while the incumbents are distracted, and while you may be able to tune your product to do interesting things.
How about compensation? There's a question in here about compensation coming up and what's happening. What can they expect? And if you are blessed to be in a hiring mode, what should you be thinking about in terms of compensation?
So, I think, I guess I don't have any sort of real-time data. Just some of the patterns I've seen is that quite a large number of companies are doing pay cuts across the board. Seniors taking more and more junior people taking less. And that primarily is because it enables them to extend the runway until the next financing period. So I think that's both a reflection of helping the company to succeed, but also just a reflection, like the cost of living has gone down, which not from a good reason, but it's gone down. So I would say, and people are looking for work right now. So I think you kind of have to be fair and equitable across the organization. But people are willing to take salaries that are below market today, what used to be market, because that gives them an opportunity to grow. And so, I think you as a CEO, you have a responsibility to okay, it's great that we can give people jobs, but, if our previous salary was whatever, 150K, then maybe this person will accept something for 125K. And of course, as things start to come back, you can perhaps rebalance that to what is, but salaries have absolutely come down.
Great advice. There are a lot of people on the webinar today who also are looking for their first time funding. I know you made a big announcement today. You do seed and A investing. So tell us what it looks like for those companies who have a new idea, a new concept, and are going to take advantage of the opportunity in the market right now. And what can they expect? And what are some of the unique things that NFX is doing?
So we just announced this morning. It's a complete coincidence that I'm doing this conversation alongside this announcement. So we announced this morning a service which essentially enables us to streamline and make fast decisions for seed stage companies. So specifically, what we're offering is $1 to $2 million for 15% of a company. So the bands are really like, if you're early seed, then 1%. If you're a later seed or potentially seed extension, it's $2 million. And we're doing this through an application process where founders submit some information, and that enables us to essentially kind of run it through our sort of internal workflow to give fast decisions. So we'll give feedback within 3 working days of submission, an investment decision within 9 working days.
Amazing.
Doing this all remote over Zoom, on email. And, you know, while I think many venture firms are like finding it difficult to react to this remote world, we're very much leaning into this. Say, well, we've been running kind of in a remote digital environment for a while, meeting a lot of founders virtually. And we think this is a time when there's many terrific companies and many terrific founders. This is time to lean in and to support them and invest. So fast.nfx.com is our initiative to help to sort of unblock the blockage within venture. But outside of that, I think it's you know, that part of the reason why we're doing this today. We've been planning to do it for a while, but we turn it on sooner rather than later, really because I think we've seen a lot of investors that are struggling to build relationships with founders virtually. They're typically run in a, you know, there's partner meetings on Monday where you have kind of a dozen people around a table, and that's the way they've been used to operating for potentially decades. And we think the world's changed, and so we want to make fast decisions quickly. So I think founders, you know, outside of NFX should be sort of prepared for slower moving processes, which, and having a pre-existing connectivity is clearly going to be helpful. And we ran a founder VC survey that we published about 10 days ago, which said that investors are, the sort of valuations have come down at the early stage somewhere in the 30% range on average. So valuations have come down, and that, you know, that's going to be a distribution, but it sort of reflects what's happening in the public markets as well, where the indices have come down similar amounts. So I would expect early stage companies on the sort of seed versus later stage. I think it's particularly hard for growth stage rounds right now. So if you were looking to raise a $20 million round, good luck. I think it's really challenging. But if you're looking to raise $1 to $2 million, and you're a great team and early on enough to sort of react to the current environment, I think there's still plenty of capital and plenty of great investors out there.
Is there any advice you give about, you know, other sources of funding, angel investment, which might operate slightly different than venture or debt financing? What are the options, and would you encourage somebody at that seed or A stage to do that if they can't go through venture rounds, given that, as you said, a lot of the venture industry is gummed up right now? Thank you for leading from the front with NFX. That's an amazing process that you're going to bring forth, but there's obviously a limited number of companies that you'll be able to fund directly. So yeah. What are the other options that are available?
Well, I think certainly, you know, SVB and others are providing kind of some flexibility on their terms. You know, sort of, I think you just need to be very careful around debt in this environment, because, I mean, it's a bit like, you know, let's just say house prices are falling, taking out another mortgage on your house because it's a debt instrument can be very challenging and risky for founders. So I'd be cautious on debt, but kind of SVB and others are kind of thinking more, being fairly flexible. And then in terms of angels and other investors, there is I think, you know, the reality is they're looking for good deals and they're opportunistic. And so if you can provide a good deal for them that is simple and quick, then there may be capital available from them as well.
Great. For those, we have a couple questions coming in without getting into the specifics of their business, but it sounds like, you know, what are the criteria, the milestones or metrics that you would want to see as from seed to A, and maybe the A to B investors, those earlier stage investors? What are the milestones that you want to see in order to be opening up and making an investment for organizations? So give a little bit more guidance on what's going to separate out the winners.
Go on. I mean, it's super hard right now to kind of give specific metrics. I think you're just from a sort of practical basis? Like, how are your cohorts? How have they changed? Have you got high retention or low retention? If so, by how much? And then on the sort of scale of these metrics, like, is there one thing that investors are looking right now is, what is the downstream financing risk of this company? And so many investors who are looking at the kind of Series A stages are generally reticent to take financing risk. So if you can paint a path that with this funding, I can see a path to profitability with these existing metrics, and it's a reasonable Series A kind of fundraise, then I think you get investors excited. And so, I think investors typically able, they'll take execution risk, they'll take product risk, they'll take team risk, but they will not take financing risk right now because they have no idea what's going to happen. So figure out, look at a way to take out that funding risk from your plan, fundraising risk from that plan. So with this money, you can see a path of profitability. Clearly, if things get better and as you sort of execute on that, you get closer to the lines crossing, then you can double down and raise the next amount of capital. But I would take financing risk off the table. Certainly, the companies that are growing in this environment, like, and if their expenses and unit economics are not upside down, then they should be able to raise capital.
How about a twist on that is somebody who looks like they have some good unit economics in their core business, and now they're looking at a product line extension or expansion opportunity, and wondering what the appetite will be for that type of expansion opportunity and what they need to show in order to get an expansion opportunity funded versus just kind of sticking to their core business and being good at what they do today.
It very much depends on kind of the expansion opportunity. Is that going to be a net positive? Is that a sort of corona positive environment, a corona positive situation, or negative? And I'm assuming it's a sort of positive, otherwise they wouldn't do it right now. I guess I think investors are generally going to be quite nervous about expansion line opportunities. There's a sense that if you're an investor, you're either going to put capital into a kind of new company with a sort of a new idea with a strong team versus a company that's trying to do two things, and with sort of unproven opportunity with the expansion, then I think it would make many investors nervous, unless it was, you would sort of almost pivot resources from the old idea to the new idea. I think one of the things that I've learned through operating is that focus at this time is critical. It's really hard to be successful with multiple product ideas. So if you're able to, to actually just focus on one thing is much more attractive to investors.
Great. I hope that was helpful to the individual that asked that question. So Pete, we're kind of up against time, but I'd love to, is there any more guidance you would like to give the group here? Because I'm sure they've all hit your website at this point and have looked at the opportunity to send in their companies for investment to you. What is your investment thesis? What are you interested in, to help give some guidance to folks who might be interested in taking advantage of this new program that you have?
Well, I think outside the program, just like, what are the opportunities right now for companies? And I think this is, I wrote it in the article, but this is actually a very unique and attractive time to start and scale a business. And I think that it may not feel like it, but you've got this massive supply-demand imbalance right now, where markets are typically in equilibrium, and you've got massive breakage in that equilibrium right now. And so that creates a terrific opportunity for fast-moving startups to capture that opportunity. It's also just like costs have come down for many startups. The cost of hiring talent has gone up. This is a terrific time. So where we're seeing opportunities is primarily where we see this sort of massive mismatch between supply and demand. specific examples that we're seeing. Obviously, things like labor marketplaces and remote work. It's, you know, the demand side is perhaps not going to pick up for a while, not in every area, but the supply side is widely available, and the economy will come back in time. Supply chain disruption, potentially education, you know, education and healthcare both being tough spots for people to invest in because of the sort of consumer inertia and regulatory restrictions, but you could see those freeing up in this environment. So we think education and healthcare could be interesting sectors that are so enormous and ripe for disruption. We're also seeing like things which are categories where people have time. So gaming, entertainment, like there's been a resurgence in these areas, which you know, gaming companies, you know, are fairly recession proof. And then also just remote work applications, like how this, you know, much as we'd love to go back to our offices tomorrow, I can see us in a period of sort of permanent or at least temporary transition for many years, as we kind of, as things slowly get back to normal. So I think those are the opportunities right now as I see them, and I think there is just to have that confidence that things will return. There will be a light at the end of the tunnel. Have faith in the human race that we'll figure this out and we'll get through this. And the startups that get through this are going to become extremely valuable businesses.
Do you have any advice for somebody who, because I think this is the hardest one, is that statistically speaking, not every company is going to succeed. That's a lovely, like, I agree with you that there's tons of opportunity coming, but some people won't. And so your final parting conversation on how to navigate that situation and rebound into it. You're an entrepreneur. The statistics are against you. These are incredibly tough times. I don't think people should take it personally that, you know, if they find themselves on the wrong end of this environment, but any words of encouragement for people who might not make it through?
Yeah, I think there's you know, I guess a few thoughts. Like one is just that there is you know, for startups in general, it's better to have tried and failed than to have not tried at all. So I think this is, you know, this is going to suck. It's going to be horrible. But if you communicate effectively and well to your investors, and are sort of respectful and thankful and transparent to the process, then you will come out kind of in a very strong position. And I think this is, you know, your reputation as a leader is going to be really important. And I've backed a number of companies that have that failed. I said to the CEO at the end of that, you know, while this is terrible, I will back whatever you do again, because I think this was like, you're terrific. This was kind of didn't work out for a variety of reasons, but because the way that you held yourself, I will back whatever you're doing. And I think that is the same for many investors. If you're able to kind of show the constituents how professional and how thoughtful you are, they will back you again in a heartbeat. So that would be one. The other is just sort of, you know, going back to 2008, 2009, there are many companies that got acquired in acqui-hires from some great companies, and ended up becoming sort of way more financially successful than anyone would have imagined. And so sort of finding, you know, if you're a C-stage company that's looking to be acqui-hired by a kind of Series B company for stock, actually may be terrific. You know, so, you know, Airbnb, Facebook, many others bought lots of these companies, and they came out, you know, the founders did extremely well. And so I think I would, and those conversations can take time to develop. So I wouldn't be, it may not seem like a sort of success, but financially it could be an enormous success.
Well, thank you so much, AC. We're right on time. It's a great note to end on. Thank you for sharing all of your insights, both as an operator, an entrepreneur, as well as an investor. And we appreciate you leading from the front and kind of ungumming up the system through NFX's new program. And so thank you so much for sharing all your insights and being so candid with us today.
Thank you, Pam. It's great to be in. Thank you for all the Aureus community does.
Thank you.
Stay safe, stay healthy.
Likewise. Bye.
Take care.